The tech sell-off continues. The US inflation numbers just came in and it's really hot. So in this video, I want to go over some statistics, share my thoughts on how that impacts retail investors like me and you, and answer whether I'm going to sell all of my tech stocks. As usual, this video is not financial advice, it's just general information for entertainment purposes. So the Bureau of Labor Statistics recently just released the April results, well, the April numbers for the US. And I want to go through this graph with you before we dig into the actual CPI, because I think this is super interesting. So if you look at this graph right here, majority of the economists was expecting around a 3.6% inflation number for the month of April. The high end is about 3.9%, the low end is about 3.4%. The majority of the people were expecting about 3.6%. The actual number was 4.2%, which is so far away from what everyone expected. That's one of the reasons why the market absolutely freaked out overnight. Now, this is from the US Bureau of Labor Statistics. I'll leave a link in the description box below if any of you are interested. And we're just looking for anything that really stood out, right? So the consumer price index for all urban customers increased 0.8% in April. Okay. So this is a key sentence here. Over the last 12 months, the all items index increased 4.2% before seasonal adjustment. This is the largest 12-month increase since a 4.9% increase for the period ending to September 2008. Okay. Now, that's massive. And let's see what else is a standout. The index used for used cars and trucks rose 10% in April. 10%. This was the largest one-month increase since the series began in 1953. I am personally part of the school of thought where I think that the used cars and trucks will be kind of a one-time thing because of supply constraints, and also because you can't travel internationally. People wanted to take road trips, and not to mention they might not want to take, public transport, but want to have their own transportation. So there was an article that was written specifically about this on Bloomberg. And for me personally, I think Bloomberg is a much more trustworthy source of information. And I'll just read you this sentence. Most analysts say increase in car prices, like the spike in inflation as a whole, will likely be transitory as production ramps up and demand subsides. Auto sales have soared amid a pandemic-era boom in road trips and hesitancy to take public transportation, trends that look likely to fade over the coming months. That makes sense to me. I don't necessarily think that trend will last, but we'll see over the coming months, right? It's not going to suddenly disappear, but I frankly think this will come and go. So I'm just going to scroll down and see if there's anything else that really stood out. I'm just looking for anything that kind of really stood out, right? So food, okay, energy. So I think energy commodities like gasoline and fuel oil is probably going to be a little bit higher for the month of May just because of the pipeline disruptions. Well, they got hacked. But it has recently came back as well. It's probably not that big of a disruption, but we'll see how that goes. Utility for gas was pretty high at 2.4%. We already talked about used cars, and also transportation services was 2.9%. Okay. It definitely doesn't help that we currently have supply chain bottlenecks. And that's probably one of the reasons why it's pushing those prices higher. And honestly, it seems like it's going to take a little while to sort itself out. One of the ways to tell whether supply chain issues are getting solved is via the manufacturing PMI, but more specifically at the supply delivery time. Now, PMI stands for Purchasing Managers Index. It's one of the ways to gauge whether our economy is in expansion mode or contraction mode. When PMI is above 50%, we're in expansion territory. Below 50%, we are in contraction territory. So technically, when we look at the PMI, we are still in expansion phase. And if you scroll down a little bit and look at the supply deliveries, you can see that the spike went up and is slowly correcting itself. It's honestly just telling us that deliveries are taking longer than usual to reach their destination. Now the question is, what do I make out of all of this? I have 3 points to share I think that are relevant for retail investors like me and you, and then I'll wrap up everything with some closing thoughts. Firstly, in my coming inflation crisis video, I mentioned that because of the combination of the Fed printing money, and also this time the money is actually ending up in people's hands via fiscal policy, I think it's reasonable to think that inflation will be higher than expected. And that's not even taking into account the massive infrastructure stimulus that the current administration is proposing. This is what the co-CIO of Bridgewater Associates said about his expectations of inflation.
For now, any downturn is going to be hit by fiscal. And while I expect you'll get a major infrastructure bill despite not having much bipartisan support for it.
So what Greg is saying here is that even if both parties in the US cannot agree on the same thing, it's very likely that a major infrastructure bill will be passed. And that means more spending.
Simultaneous to that is the past fiscal policy still hasn't flowed through because of the pent-up demand due to the pandemic that's still there. If you look at household savings rates, they are still excessively high. They're going to come down almost certainly by the end of the year. You're looking at demand increases in the US economy, we'd say from 8 to 10%. Now, a lot of that, some of that will pull from real GDP, but some of that will probably create even further shortages and more inflation over that period. So you'll be looking at significantly higher inflation than the Fed expects when you're looking back a year from now.
What Greg is also saying is that the previous stimulus checks are also sitting in people's savings accounts, which is one of the reasons why savings rate is so high at the moment. He thinks towards the end of this year, that excessively high savings rate will eventually come down, pushing the demand higher, driving inflation higher than what the Fed is expecting. For me personally, I think that inflation numbers that we saw in April is just an entree. May could potentially be worse because of base effects. Secondly, because I think that we are going to get inflation higher than what the Fed is expecting, growth stocks, especially the ones with no cash flow, will be beaten up really badly. That was one of my mistakes earlier in the year where I had too much exposure to growth stocks with no cash flow and I didn't clean them out fast enough. So it was definitely a tough lesson to learn. Since then, I've really built on my macro understanding of the world and how that impacts valuation. And I've allocated more capital towards assets that will protect me from inflation. So more allocation towards Australian blue chips, commodities, and reduce my exposure to basically growth stocks with no cash flow. I also want to point out that I am incredibly fortunate to be an Australian investor because a lot of our blue chip companies are things that will do really well in high inflationary periods. So miners, industrials, financials, they tend to hold up really well during high inflationary periods. I don't want to keep suggesting the coming inflation crisis video, but towards the end of that video, I actually did document what JP Morgan have said, what asset classes have done really well for high inflation periods. Lastly, which is kind of a question that's looming over everyone's mind, am I going to sell my tech growth stocks? The answer to that question is quite simple, and I want to answer it by asking you a question, and I would love to know what you think. Do you think because our economy is reopening, people are spending more money, therefore potentially driving the prices up further, companies are really going to stop spending money on digital transformation? My personal belief is no. I will actually argue that because of the increased spending driving the prices higher, which ultimately could lead to wages growth, it's likely that companies will need to invest more in their digital transformation in order to compete against others who are more digitally equipped. I'm actually really optimistic about tech growth names, but because of how bubbly those valuations are, I never really had a chance to go in on any of those. So now that finally prices are correcting, over the next few months or the rest of the year, high quality names will finally go on sale.
Thank you, Mr. Market.
And we get to go shopping, finally buying some stuff at a discount. So I am definitely not selling any of my core growth holdings. But in saying all of that, it doesn't change the fact that we should continue learning about the macro environment, the industry we want to invest in, and definitely the company within that industry that we want to invest in. Don't worry, as the story develops, I'll share all of my thoughts here so that we can keep this conversation going. But the one thing I do ask of you is that if you want to be updated, just make sure you subscribe to my channel and click onto the bell so that when those videos are live, you'll be notified. So here are my closing thoughts. I'm expecting inflation to run hot. much hotter than the Fed expects. And I think the economy on fire would be an understatement. So acknowledging that, as a retail investor, I will continue to position and protect myself with assets that will perform well or hold its value in high inflationary periods. At the same time, as high quality growth stocks go on sale, it's very likely I'm gonna go shopping at a discount. But the most important thing during this period is actually taking care of your physical and mental well-being.
I know that sounds incredibly out of the box and very woo-woo.
But ultimately, investing and life in general is an accumulation of high quality decisions. Now recently, I let my own well-being slip out of my hands, and the quality of my decisions also went down the drains. So while we get through this really tough period together, I will keep you posted on the stock market, economic, and from time to time crypto news, but you gotta take good care of yourself. So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors, and see you very soon.